Here's how to find your draw on liquidity when you have a very strong draw above and below price. And it's all going to be done through the idea of high resistance versus low resistance. So high resistance is a high or low that we don't expect to get traded back to. And this is shown when we tap into a high time frame PD array, we get displacement from that, creating aligning bias PD arrays. Now what is low resistance? Low resistance is a high or low that we expect to get ran with ease. And this is usually in the form of unmitigated fair value gaps and low resistance liquidity or an accumulation zone. So how could you have used this idea to find your draw on liquidity today? Well, as you can see, we're inside this 4 hour. However, how do we confirm that this is high resistance? Well, if we go on the lower time frame, you can see we're displacing away where we're creating aligning bias PD arrays and we're respecting them. So it puts us in a scenario where we have an accumulation zone or low resistance liquidity leading up to all-time highs at the highs, and then we have 2 sets of high resistance below defending the MWOG. So price now has 2 options. Either it trades against the trend through 2 sets of high resistance to get to the MWOG, or it trades through an accumulation zone and low resistance liquidity to get to all-time highs. And more often than not, price is always going to choose that easier low resistance run. And as you can see today, the leg that came from the 1 hour bullish imbalance then sponsored a 30-minute where we tap into it and then instantly trade to our DOL above.